Good morning, everyone. Major changes have taken place recently, so thank you for taking the time to join today's webinar. The finalised guidance regarding the allocation of professional firm profits is a real game changer for clients operating in the professional services space. The current financial year ending 30th of June 23 marks the end of the first financial year during which the new guidelines regarding the allocation of professional firm profits comes into effect. We want to reach out and not only make you aware of the changes to these rules, but also provide options and a strategy to be comfortable with decisions regarding the allocation of profits this year. We're also expecting that for most taxpayers affected by the new rules, in order to adopt a low risk position under the guidelines and stay off the ATO's radar, more tax is going to need to be paid. So it's important to understand and plan for these upcoming liabilities. For those of you who don't know me, I'm Daniel McCulloch. I'm a chartered accountant and an associate at Smart Business Solutions. I have 15 years experience providing tax and consulting services to small and medium businesses, and I specialise in assisting clients in the professional services space and medical spaces, and therefore well placed in applying these new guidelines. We've previously put out a more in-depth presentation looking at the application of these rules in detail. So today's presentation is going to be more of a condensed refresher of the guidelines, and we'll be paying closer attention to what this means for you in a practical sense, what actions you need to take today to remain in compliance and get the best possible outcome this year. So just to recap the contents of today's presentation, so we're going to again look at what these rules are all about. We'll summarise the differences between the draft guidance and the finalised version. There's not really that much to see there, but a couple of minor points. A brief recap of the application of the guidelines and the risk ratings and what this means for you in a practical sense. So to quickly recap what this new PCG is all about. So the new guidance in PCG 2021-4 marks a real shift in the way that professional firm profits can be allocated or split among a family group from 1 July 2022 onwards. The outcome of this, unfortunately, is that for most professionals, you're going to end up paying a larger amount of tax in 2023 and onwards than you have in previous years. So at its core, the PCG is a targeting system for the application of ATO compliant resources, and it applies when a firm's income is not subject to the PSI rules. It sets out the likelihood of a taxpayer becoming the subject of a review or an audit if the ATO feels that there's an inappropriate allocation of income. The ATO is mainly concerned that certain business structures that are used nowadays in professional services firms are producing artificially low returns of income to professional practitioners, while at the same time associated entities benefit and the commercial reasons don't justify the arrangements. So to have a quick look at the guidelines in action, this is a really simple example, but to give you an idea if this is new to you. The ATO's primary focus is on situations where income is redirected. So where income is redirected from a high income earner, a professional practitioner, to entities on a lower effective tax rate. And this has the impact of lowering the overall effective tax rate for a group. So as an example, medical practice may operate through a medical practice company and a related service trust. Profits of the service trust may be allocated to a spouse or adult children who are in a lower tax bracket, whereas the net profit of the medical practice company generally should be paid to the practitioner. In this situation, the combined arrangement could come under ATO scrutiny if the percentage of the overall income returned by the individual practitioner and the effective tax rate on the overall practice income do not fit into the ATO's low risk zone. So now let's have a look at the draft versus the finalised guidelines. So there's some minor changes here, but nothing that really changes the flavour of the guidelines. The final version essentially reproduces the draft, which was issued for comment in March 2021. The primary difference between the draft and the final PCG is the start date was deferred by 12 months. So it applied from 1 July 2022. And it's worth noting that that's for those arrangements in compliance compliance with the suspended guidelines that are both commercially driven and don't exhibit high-risk features. The 2-year transitional period has also been extended to 1 July 2024 for arrangements entered into prior to 14th of December 2017, which had a low risk rating under the old guidelines, but a higher risk rating under the new PCG. And the finalised guidelines also contain some further explanations and examples that make applying the rules and understanding how they work easier. So the steps involved. So this diagram summarises the steps involved in applying the guidelines. It consists of 2 gateways, an application of risk factors and then a scoring system. To determine whether the PCG applies, 2 gateways are used to evaluate whether an arrangement has a sound commercial rationale and doesn't exhibit certain high-risk features. If you can't pass the first 2 gateways, then it's actually not possible to self-assess against the risk factors and apply the remainder of the guidelines. So it's really important that we can satisfy these gateways. So let's have a quick look at those in a little bit more detail. So gateway 1, so the first gateway that needs to be passed contains the requirement that an arrangement have a sound commercial rationale. What this means is that there needs to be both a genuine commercial basis for the arrangement and also the way in which profits of the business are dealt with. As an example, it should be really logical how a certain structure assists or improves a business's ability to make profits. A logical explanation of how this works will go a long way to satisfying the first gateway. Factors of concern to passing the first gateway could include whether an arrangement includes steps that appear only to provide a tax advantage. So this could be the case where we have a structure that appears to be more complicated than it needs to be, and at the same time, that structure may have the effect of producing a tax benefit to the parties involved. Whether the parties are operating on non-commercial terms or in a non-arm's length manner is another factor of concern. So this will be very common in family businesses and small businesses in general, where oftentimes people won't be dealing at arm's length. And I guess a third factor would just be whether the individual practitioner is receiving the amount of income that reflects their personal efforts. So if they were to simply go and work for a business that was unrelated, is their remuneration in terms of their current business roughly equivalent to what they'd be receiving on the open market? The second gateway is that the arrangement can't contain any identified high-risk features. And so examples of those are features that have been covered by a taxpayer alert, so something that the ATO has put out and sent to tax practitioners, financing arrangements relating to non-arm's length transactions, exploitation of differences between accounting standards and tax law. So an example here would be enabling income to be assessed to entities that pay little or no tax, while allowing others to enjoy the economic benefits of the profits. Assignments that are materially different from Everett and Galland, and multiple classes of shares and units held by non-equity holders. The ATO provides a number of further examples and guidance of the high-risk features in the finalised guidelines. So I'd suggest that you do take the time to have a look at that at some point. So assuming that we can pass Gateway 1 and Gateway 2, we're now in a position where we can apply the risk factors and determine a score. So where an IPP passes the gateways, we're going to self-assess. And there's 3 risk factors under the framework, and they are: number 1, the proportion of profit entitlement from the whole of firm group returns in the hands of the IPP. So basically, what proportion of the total profits are assessed to the professional as opposed to other parties. The total effective tax rate for income received from the firm by the practitioner and associated entities. So now we're looking at the whole of firm income and the rate of tax paid on that income. Obviously, the higher the effective tax rate, the lower the score under the risk rating system. And thirdly, the remuneration return in the hands of the professional practitioner as a percentage of the commercial benchmark services provided to the firm. We've actually covered these risk factors in detail in a previous presentation, so I'm not going to spend too much time recapping this today, but I think it's worthwhile revisiting what the overall risk rating means for taxpayers in a practical sense as this year draws to a close. So as I mentioned, scores are assessed by determining the aggregate of points accumulated against the three risk factors we just outlined, or 1 and 2 only if the commercial benchmark is inappropriate to use. To put it in really simple terms, the higher the accumulation of points under the risk rating, the higher risk the arrangement may be considered and the greater the likelihood of attention from the ATO. So if we're using all three risk factors, a score of 10 or less is required to be in the green zone and considered a low risk arrangement. If using risk factors 1 and 2 only, a score of 7 or less is required to be considered low risk. Key takeaways here. Our expectations are that for most practitioners to remain within the green zone and thus be considered low risk. The effective tax rate for most groups will likely increase for FY23 when compared with prior years. We've been trying to do some calculations to get a feel for exactly what this might be, and I think what we've landed on was around maybe a 5% increase to most clients' effective tax rates. So it could be material, and so that's why we want to make sure that we're undertaking appropriate planning and really looking at these guidelines and how they work in detail. So the next question is, what does this mean for you in a practical sense? So we've got a traffic light system here. Obviously, we've got the green zone, which is low risk, and we've got the red zone, which is where we really don't want to be. Assuming that you fall in the green zone of the low risk category, the ATO have provided some commentary, and basically what they're saying is that they will only commit compliance resources in exceptional circumstances. So I just note that this isn't a safe harbour. It just means that unless given a reason to look further, the ATO have stated that they generally won't commit resources, compliance resources to low risk arrangements. Some clients are going to end up in the amber zone. And for these types of arrangements, it falls in the moderate risk category. So the ATO is likely to conduct some further analysis, including inquiries to understand more about the taxpayer's situation and the reason for the increased risk assessment. So the way that we see this rolling out in practice is that they will likely request a copy of the assessment under the guidelines. It's worth noting also that even in the absence of receiving a document, say that we've prepared or the client has prepared, the ATO likely already have a good idea of where taxpayers and groups are likely to sit. So there's a lot of benchmarking that happens, a lot of disclosure items that go into tax returns that are used for purposes of, as I said, benchmarking, and that's where we think that the ATO will gain an understanding of the business and then be able to approach for more information. For high-risk arrangements, it's likely that reviews may be commenced as a priority and even in some cases proceed directly to audit. So how we can help. So we want to engage with clients early to provide options for consideration. So the PCG isn't law, so it just sets out the ATO's compliance approach. As I said, there's going to be some evidentiary requirements regarding documentation of the assessment with the guidelines. So I suspect that a lot of clients are going to need some help to have that on file in the event that it's asked for from the ATO. There's probably going to need to be some additional planning for increased tax liability. So for clients that weren't across this previously, we are expecting that if you want to stay off the ATO's radar, additional tax is probably going to need to be paid to remain in that green zone. So yeah, there's going to be some planning in terms of the payment of tax that will need to be made this year. And then there's a reassessment on an annual basis. So we'll need to complete this annually for clients. And so it's not a one-time thing. Next steps. So we'll be reaching out to clients that we know are affected by these new guidelines. We're going to be doing a lot of work in conjunction with the tax planning more broadly. And so we think this is probably the best time to look at this and formulate a game plan for the year. If you or someone you know are potentially impacted and unaware of these new rules, or would simply benefit from a chat or some advice, we'd be happy to discuss further and see how we can assist. Our leadership team of Smart Business Solutions, we're headed up by Shannon Smith, founder and managing director. Paul Cunningham is also available to assist clients, so you may know Paul or myself. Thank you for joining today's webinar. I hope you found it helpful. There's been a lot of changes this year, and so I'm sure that you're seeing a larger volume of emails coming through. And look, we want you to understand that this isn't coming from us. The ATO sets the rules, and we're just trying to manage this as best we can for clients. So feel free to reach out if you wish to have a chat, and we'll be in touch shortly. Enjoy the rest of your day. Thank you.